Today, we have a guest investor on who is a corporate finance math nerd by day, risk taker, pilot, motorcycle rider by night, and real estate investor out of California. All right, welcome everyone to your weekly edition of the Not Your Average Investor Show. I told you I'd go Ace Ventura, Jeff. I'm your host, Pablo Gonzalez. With me, as always, the man that I affectionately like to call GC, because he's got the genius concepts, knows how to generate cash flow. It's a great host, and because his name is Gregg Cohen. Say hello, Greg. I'm having a hard time talking today.
You'll get there. You'll get there eventually. Hello, everybody, and fantastic to be with you today.
Star of the show today, coming from the great state of California, just outside of my favorite national park. He is a corporate finance guy, has his own investing philosophy that he even put an acronym to. We have another Zach Correa is the only other guy that's come out here with his own acronyms. This is another Zach Correa faking a non-British accent today. Sir Geoff Bolton, sir, welcome to the show.
Well, thank you for having me.
So Jeff, as far as you said you were familiar with the Jacksonville market because your dad lives here. Did you consider other markets, like as a guy that's like poking around at the risk thing, or was there partially like a comfort/emotional piece of why you're going to go Jacksonville market?
I think there were a couple of factors. So, and it's a great question, right? You look at all the markets and the market dynamics. If you're going to outsource, and it comes back to my professional, audit background and stuff. There's kind of a rule in that the audit, you can outsource your business operations. Hire ADP to do your payroll. You can't outsource responsibility. So you ultimately are still accountable for everything ADP does on your behalf. And so there's that. I either had to do it locally and run it myself, or I had to find a company that, I could outsource the operational component of the day-to-day management to, that I was comfortable with going to run it the way I would run it. And actually, I would say probably better than I would run it would be my hope, right? You're going to hire a professional. You want them to do something better than you can do it yourself. And I think, it took me a while to get comfortable. And certainly since then, some of the other companies I interviewed and looked at that were in the space of turnkey rental, the stories have gone sideways on some of those businesses. I'm comfortable. I made a decent call on JWB.
So you said that the sales call made you comfortable. Was there, I do remember you being part of the show before all that. Like, did you, or not? Did you come in afterwards? Like, was there anything? I'm trying to like prove to Greg how valuable this whole show thing is, right? but I want you to tell the truth. Like how much did you kind of like gain from the podcast or the show or the community or any of that stuff? Or did you engage with that afterwards?
I have no recollection of the sequence of events there. So
okay.
Not sure, which one came first, the chicken or the egg, but certainly looking at, and I go back in my mind to some of those earlier shows and, Greg talking about a full market cycle and, those things are still running around in the back of my gray matter, and I remember at the time was interesting was Greg wasn't talking a lot about home price appreciation in those calls. He was talking a lot more about trusted partner and how do you manage this? And you got to hang on to a full market cycle because real estate's never lost in a full market cycle. And how do you not get taken out, in a market correction where you're forced to sell and now you're selling at a discount and you lose money, and also how not to worry about when the toilet backs up. The horror story of single family rentals, the 2 a.m. call that my toilet's clogged.
I think you and I, we could get the opportunity to go out and get a beer. We would sit around and we talk about, all right, how to avoid the worst case scenario, and how do we make sure we assess risk, and how do we make sure we have money set aside for the worst case scenario? Because that's how my mind thinks too. And that's a reason why I love single family rental properties. I know it's important for you to make sure you're prepared against the things that can cause stress or to cause you to have sleepless nights. That's why this asset class works so well. I'm really curious though. I know you mentioned the sales process with JWB. What was it like talking to other providers? What were the key differences there?
It's felt more like the pump and dump. Pump up the property, talk about you're going to, last year people made 100%, gain on equity. And I'd look at the numbers spreadsheet guy, right? I'd look at the spreadsheet and I go, you don't have vacancy in here. You don't have properties wear out. You have to have a reserve for the roof in 20 years, the hot water heater at 7 years, and get your team ready. My approach to hot water heaters, I'm leaning towards, curious what your thought is at 7 years, at that tenant turn, we're putting in a new hot water heater. Because they fail, and when they fail, they tend to cause a flood, and that's bad for my resident. They have water in their house, water damage, and they're taking cold showers. And I've got to replace that hot water heater on an emergency basis. I'd rather just preventatively take it out at 7 or 10 years or whatever, and it's the right spot, and provide a better tenant experience, not get the 2 a.m. call, and also, how my house is worth more. Got a new hot water heater. And I think when we get into how I manage the cash flow on the property, I'll be buying that hot water heater with the tenant resident's money because it's set aside to account for that future event. It's known stuff wears out.
Seems like a pretty good segue to get into it.
All right. All right. I was going to talk about yes.
Well,
let's get into it.
Or I can get into it. I just don't want to steal the thunder.
Why don't
got an awesome presentation.
Yeah. Why don't you get into it, GC? Why don't you just take the reins?
You're going to give me the reins?
Just go for it, bud.
I'll take the reins.
Let's go for it.
Well, let's talk a little bit about how would we make that decision? I think and what everybody will kind of get out of this call beyond learning about Geoff's strategy is just to understand how proactive Geoff wants to be.
Mhm.
And he is willing to do the things, not just to make sure that we're taking care of the resident from an experience perspective, but to make sure the money is set aside so that there are not sleepless nights for him. There are not sleepless nights for his resident. And I think that is such an amazing mindset going into this asset class, because if you have this mindset, you are going to see that full market cycle. You are going to be in the game. And just like Geoff was remembering about all the times that I've shared with everybody, listen, it's like knowing the answers to the test. If you just simply hold on to this asset class for a full market cycle, you're going to do really well. And you can just ask anybody who's owned single family rental properties for at least 10 years, ask them, how do they feel about it? And they're going to say, you know what? I did quite well financially. So it's just so great to have that mentality. I hope that's the biggest thing everybody takes away. Now, when we're talking about specific things about, how proactive do we want to get, that's where our team's experience is the best thing to help you make the right decision. Specifically on that water heater example, I think that there's more to do than just simply saying when it gets to 7 years, we're automatically going to replace, right? But we can start asking some questions. And I think at the essence, what we want to do is we want to be proactive. We want to be proactive to make sure that, first of all, that the money is set aside to take care of that. We're not afraid to spend money ahead of time before something breaks to make sure that it's a great experience and to avoid future maintenance costs. But if I was going to share a little bit of thoughts or advice on that, I would say, Geoff, let's not just be hey, listen, at 7 years, we're definitely going to do this. Let's start asking more questions at 7 years. If we need to get eyes on it, we need to run, an inspection on the water heater or whatever major appliance we're talking about in the house. That's usually the way we're going to want to go about it, because at the end of the day, our job is to manage your return on investment. And if we are so proactive that we're fixing things that truly are not about to break, then we run the risk of you sleeping well at night because you don't have unexpected expenses, but we're not delivering a return on investment for you. And we can't go so far down that line as well. But I just think that's where our relationship comes into play for those types of decisions.
Yeah, and Greg, I factored the cost of that hot water heater into the return on investment I expected. So it's already budgeted, right? So that's part of my philosophy here is, I wanted passive, and it is very passive. So with a little automation and banking set up, I've been able to get it to where, to manage the whole portfolio, including conversations with you all, Granted, this month that's going to be probably about triple because I spent an hour on this call. The normal time I spend on a month, I can manage the business, shall we say, in 15 minutes a month and look at the return. So that's super passive, but I still have control, right? So
Yeah, let's dive into a little bit more of that, right? So I think we're kind of like teasing this like proactive control, and I'm starting to make my own conclusions of what the storyline is here. But first, I wanna just get into it, right? Geoff, you sent us kind of like your ideology of it. We know that you are risk averse. We know that you are a W-2, high stress, high workload. You want to be super passive, and you definitely don't want to like feel like you are coming out of pocket on a capital call. So and your overall goal is to create a pension fund for living expenses that keeps pace and outgrows inflation. You're looking long-term opportunity, and you care about kind of like the experience that you're giving to your residents, right? Like, so we've kind of like talked about all that stuff right now. And then you came up with this acronym, SWAN, right? Sleep Well at Night Formula. We love acronyms on the show. Talk us through what the actual SWAN formula is.
yeah, I think it kind of comes from Greg, right? He's data driven in how he runs his business. I'm data driven in how I want to run my business. As I said, I view the rental property not as maybe investments, but as a business. So I keep a balance sheet and I keep an income statement, effectively, a statement of operation and a balance sheet. And the balance sheet formula is equity. So I got equity in the properties. I bought them with equity, and that equity has certainly grown through two factors: principal pay down and appreciation, which, I'll hit on the things Greg loves, the profit centers. You got operating cash, and that's kind of it's, checking account that earns 1%. It's the initial fund buffer of cash available at a moment's notice, no need to think about, right? If I got to ding that account. Then I've got my reserves, which is a much larger account that I've been setting aside for those hot water heater conversations or reviews or tenant turn, things like that. And then I subtract out the liabilities. And as long as that's going up, I get to sleep well at night. And as I said, it's never not going on. So, from a positive perspective, I'm conservative. I track the equity, not at today's price when I look at that, but at its purchase price. And that takes the appreciation off and helps me really not pretend it's not there, but better recognize how the asset's performing, regardless of what the overall market's doing. If I can kind of take that market volatility or market making everything look good. And certainly if I go back to the syndications when I was looking at those, that market appreciation was something that was making those things on paper look fabulous, no matter how poorly they were being operated. The operational things got covered up by the market. And so I tried to take that out of my own sleeping well at night. So I know I won't fall into that trap. I do look at it, but it's maybe not my focal point.
Oh, I'm so glad you brought up that point, because behind the scenes, if you are somebody who is selling real estate and you want to get somebody really excited about buying it and you want to put some fantastic returns on investment in front of them, you do two things. You assume financing, so you put as little down as possible, and you assume a really high rate of appreciation. And that's how, if anyone is in the space and is currently looking at other evaluations, that's where you see 20%, 30%, even 40% expected returns on investment. And it's not real. It's not real. So I'm so glad you brought that up, because that really is very prevalent, no matter which, asset class within real estate you'll find that.
Yeah. It's an easy way to,
sorry.
No, I was just saying, it's an easy way to make stuff. You can frost the cake and no one knows it's made with stale bread.
Yeah, totally. And then Geoff, you have this like formula, right? Where you're keeping operating cash flow, you're keeping reserves, you have these and then you have this automation set up between bank accounts so that you don't feel it. Do we want to kind of like share that part of what you got? Cause to me, this is like truly genius, right? Like this is kind of like the long talks that Greg and I have when we're going running in the morning, and he's asking me like, he's like pontificating on this idea of like, if people don't feel it coming out of their bank account, if they can just have it like automated in a way, then that would allow folks to stay a longer time, not feel that thing. I know like Wit and Richie do this, right? Like they have like different bank accounts for different things that do this, but we've never had somebody actually come on the show and like break it down into a flow chart like you have it. You ready to talk about this?
Yeah. Dive in.
All right, let's throw up your banking buckets managing cash flow chart.
I think I started to cry when I first saw this, Geoff. I just want you to know this is so beautiful. Take it away, but I just want you to know that I had a tear in my eye.
Well, and I set this up not only with separate accounts, but at a separate financial institution. So it is fully segregated and separated. And part of it is, I think, maybe my philosophy that I feel like I have a social contract with the resident. They're paying money in, and there's a promise from them that they'll pay, and there's a promise for me that I will provide them a high quality, affordable, safe home without black mold or whatever else, Stay away from that whole reputation, I think, sometimes that landlords get tucked into as slumlords. And the psychology is really important. By keeping it separate and running it as a business in my mind, rather than it being my money, it's the business's money. And so the rents come in, they hit that checking account, JWV sends that in, and I'll probably jump around the order here because that kind of the start of the flow versus the calendar month. So maybe I'll go calendar month. First the month, the mortgages all pay out of that checking account. So they're all set up automatically. The banks just draw the money out of there. So I keep 1 month's worth of the mortgages in that as my target balance. So even if I got nothing off the portfolio, the automation's there, the rent, the mortgages all get paid. Then on the 5th of the month, I transfer and kind of reconcile my finance world and transfer out the leftover cash to get back to that 1 month balance. On the 25th of the month, JWV puts in the rent less the expenses. And then that sets me up for the end of the month reconciliation, and it just runs kind of on autopilot throughout the year. And you said, 5-minute look at the account. I know what my mortgages are. I've got that number in my head, and I can just move everything else to get the balance there. So simple math. And then as that money market keeps building up, I've got decisions to make, and I kind of look at that once a year on terms of, should I take some of that excess cash and pay down principal, maybe get a recast on the loan to increase cash flow. I use it to buy another investment. And then the one that's in kind of a reddish orange color over there on the fund side, that's probably the worst use in my mind of that excess money, but it's an option. So.
Man, I wish I knew what reddish orange was that I should follow.
It's the top one.
There we go.
Greg is wildly colorblind.
Geoff, this is so critical. This is critical to client success, to rental property investor success, no matter if you're a client with JWB. It's one thing to make the right decision on the team. It's one thing to make the right decision on the market and the property. But once you own these assets, a very simple thing like setting aside a separate bank account and properly funding reserves will absolutely make your experience 10 times better. It will increase the chances that you are going to stay in this asset class for a full market cycle where we know you're going to win. Was this just an innate thing based on your background that you knew to do this? Did you have an experience, maybe not in this asset class, but in another asset class where you said, listen, I got to separate my personal bank account from my investment account and not intermingle them?
It started from being lazy. So I knew I was going to have to figure out my tax return. And so if it's all in a separate account, then the records are segregated. They're easy to find. I can go on the bank website and pull up, here's what happened, right? And here's the mortgage payment. So it helped me from that perspective. And again, I wanted to be able to make sure that I didn't get tempted maybe a way of looking at it, right? Like if the cash was sitting in my account, maybe it goes to, a new motorcycle or avionics for the aircraft or something like that. And then and we've got other events have happened, I've had a few, I just had an HVAC repair at one of the properties we had to do, right? That comes up. Well, it's real low stress for me because, the JWB representative calls and says, we've got a $600 expense to repair this HVAC system. I just say, go fix it. And then I log into JWB's site and I fill out the little form and he sends you guys the $600. And it's done. There's no need to worry about the cash flow. Right? The reserve's there, and the tenant paid their rent all those years so that money would be there, so that there wouldn't be this, I'm not sure I can get to it today. And, you're trying to figure out how to move money around, sell stock or something like that. So you can meet the resident's need that you committed to when you rented them a home.
It's a beautiful thing. I think what you just mentioned there is that's a low stress situation for you. And that does not mean that we are happy that we need to spend money for maintenance. It just means that it is a low stress situation. It is a part of the deal. You mentioned a social contract with your resident. It's a part of the investment, right? For any investor out there, if you're thinking about investing in rental properties, ask yourself, how do I get to the place of describing when I need to send $1,000 to take care of a maintenance item? How do I get myself to the place where it's low stress, right? Ask yourself that question. This is Geoff's strategy, because if you can get there, you're still going to perform. You're still going to earn a great return on investment, but you're going to last. And the return on investment is not the hard part in rental properties. It's getting you to last. So whatever you can do to describe that type of scenario, play that scenario out in your head and say, do I have the wherewithal to handle that? How do I get to low stress? Following a system like this is a great way to do it.
Yeah, I love it, man. What comes to mind for me is we've talked at times around this concept of pulling forward demand, right? Like you see an opportunity and you want to, pre-position your portfolio in a way of where you're going to want it at the end. And we do it. I did it when I did it.
Right.
Like when I invested or whatnot, I see this almost as like pulling forward risk mitigation, right? Or pulling forward this like hedging against taking out cash flow. Cause what I hear in Geoff's strategy is that Geoff is a long-term investor, right? So like when you started explaining this whole idea of, maybe you don't pay the water heater at year 7, we're going to give you a conversation around year 10. And what I hear Geoff is saying like, dude, I'm going to buy that water heater anyways. So I might as well, and I'm going to keep this property for a really, really long time. And at the end of the day, like the cash flow is going to get to where I want it to get to, and it's going to continue to compound, and it's going to continue to do its thing. So like he's just proactively putting this thing, like pulling forward this like cash flow into a pile of money that is pulling forward this like idea of cushioning these moments of maintenance expenses so that you're not having that like we all just agreed upon, right? Like nobody loves paying an extra $1,500 for something that went wrong or more or whatever that is, right? But like if you can like pre-cushion that impact and you're in it for a long term, then he's really just like hedging against this whole like kitchen table conversation that you're going to end up having when your partner or like you're just talking to yourself is like, oh man, now we got to pull out of this. And now can we really go to Cabo this summer or not? Right. Like you're just kind of like insulating all of those decisions, Geoff. I think it's great.
Yeah. And I think my theory, when I get to the harvesting phase, right, what I'm planning to do is look at the end of the year. Okay. Let's say last year, the positive cash flow in the portfolio was $12,000. Okay. Next year, because that $12,000 in cash will be sitting in that account. Then the next year, I'll pay myself $1,000 a month out of that account. And then at the end of the next year, let's say it's a better year, I didn't have a tenant turn, I didn't have an issue than I had the prior year. Let's say it's $24,000 that I excess cash flow in the portfolio. Well, then the next year, I'll pay myself. So year 3, I'll pay myself $2,000 a month out of that account. So the money I'll be paying myself in a dividend or my pension will be trailing a year behind the actual performance of the portfolio. And that means my cash flow will be stable, it will be predictable, and it will be insulated from whatever's happening, at least for that 12-month period. That's kind of the theory I have in the end. So not there yet, and we'll see.
That's it's great to understand. I mean, when you were sharing with me why you're doing this, it revolved around, it revolved around being able to create that dividend situation for yourself. But that doesn't start day one for most rental property investors. Jeff's been investing for many years now, and now he's starting to say, you know what? That's okay for me to do sometime and maybe in the not too distant future. I think this concept of deferred gratification is one of the reasons why I love single family rental properties. And we're seeing a lot of that in Jeff's success strategy as well. So a great takeaway. But Jeff, I wanted to ask the question, okay, so we're starting to think about what to do with those funds. Maybe share with everybody how, you've built up a significant amount in your reserves, right? When have you checked that box that you've done enough for reserves? How much is too much? And then what do you do with the money when you start to take those dividends or distributions?
Yeah, I think I was getting close to that. And then there was a hurricane that came through. So I haven't made that decision yet, and we can talk about that, another way to avoid sleepless nights, right? Like there was a hurricane that came through Jacksonville and it took out a tree in the back of one of my properties and it damaged the roof, it damaged the structure. We had a vent pipe that had to get replaced. I think a raft or two had to get replaced, resheeting, tree removal to the tune of, $8,000+ hit. And I did a conversation with interesting with JWB because my first inclination was, okay, use the reserve fund. That's what they're there for, which means you guys don't have to hold off. You don't have to get an insurance adjuster out there. If I went with insurance, and I know I've got a resident who's got a hole in their roof. They're probably living the most stressful point in their life, right? Certainly a high stress moment. Their house has been damaged. And, they'll be talking about that 20 years from now. They'll be talking about how we handled that. And by we, I mean JWB and me, right? Like that's now part of their family history and story. And so my stress at having to cough up the $8,000 at a reserve account versus their stress that they're going through is de minimis. And I think keeping that in the back of your mind as a philosophy is a good thing to have there. Now, if I'd gone with the insurance, right now, I would have been on the hook for $2,500 deductible, but I own multiple rental properties and I've got a primary home in California out in the wild one where wildfire insurance is dang near impossible to get in. Don't talk to me about Florida insurance markets. I gladly compare your bill to my bill, Greg or Pablo.
Right. I'm aware.
So now I've got a claim. That means I'm in the rich bucket of more likely to use insurance. That means probably the premium going up on all those properties. So net, it's probably going to cost me more than the $8,000 if I go with the insurance between the $2,500 and 5 years of increased premium. And so, I had that choice, one or two, because I had the reserves. If I didn't have the reserves, well, it would have been between option 2 and 3, 3 being, self-stock, take a capital gain on that. So it's more cost to pay for it or being forced to use insurance. So it was real easy for me to just say to JWB, do what you got to do, get it done, get it to the resident. And that took my reserve down a bit. And so that delayed me rethinking, like, do I pay off principal on an existing property to increase the cash flow if I recast the loan? Do I take the reserve and take that account down and use that money to buy another JWB property, right? Like I was in keeping those thoughts, and then with Matthew came through and took out my tree.
Yeah. And this is a real life scenario. I'm so glad. Well, first of all, Jeff, thanks for putting the slide together. I think we shared that one, but this, again, if you're thinking about investing in rental properties, look at how Geoff just described the way he goes about this generally as low stress.
Mhm.
But he has had significant expenses. I mean, it is a part of the deal. But when you go about it, if you're proactive, you plan ahead, you have those reserves in place, you're making thoughtful, logical decisions rather than emotional decisions. Emotional decisions tend to lead to lower returns on investment. You get upset, you might sell the asset, or you have to sell some stock in order to find the money in order to pay for it, which causes other expenses. Just don't get there. Be thoughtful ahead of time. And I think the idea of paying for an expense, even an expensive expense, like we just talked about, an $8,000 cost versus doing insurance is a common question. That's one where, our team internally, along with our insurance team, can really help kind of advise you. And it's not just as simple as what's my deductible versus what's the cost? How much savings could I get day one? We need to think beyond that. We need to think, how many rental properties do you own? Where's your primary residence? Is it a location where it's hard to get insurance? Are there other natural disasters that are making it more difficult for you to be able to get insurance? Is that going to threaten that? How long are you planning on holding on to the asset? So this type of conversation is where that relationship comes into play. Most investors never even think about this. They never have the foresight to think. They don't have a trusted team to help them, and then they make the wrong decision. And then the other thing I wanted to point out is, how cool is it to be surrounded by investors who care so much about the residents?
Yeah, that's really awesome.
Every point along the way here, we're seeing Geoff care about
Yeah.
the resident.
Yeah.
And that is something I think that is unique to our community, to our client base. It is not just enough to be able to make a great return on investment here. We need to know that somebody's winning on the other side.
Yeah.
And what I try to evangelize is that when you invest in turnkey rental properties the right way, you are helping build families, you're helping build communities, you're helping build a better city. I think in a grand scale, turnkey rental properties build a better country, right? We create financial stability for both our residents and our owners. So I know it's really, really important to Geoff, and it's just not enough just to make a buck these days.
I like that piece of caring so much about the resident experience. And the other part that I like that I don't think we've just talked about is just like, Geoff, you have extreme self-awareness, right? Like you really know yourself and you know what you want. And I think it's one thing to like know the numbers. It's another thing to have the discipline and the foresight and the strategy and like the self-knowledge of like what you're in it for. Cause I think it's really easy when I think of what Geoff is doing, right? Like I think it's in that story of, well, I was thinking about debt pay down and then maybe re-upping or like buying another property or whatnot. I see you trading off this idea of no, no, no. What I care about is my comfort, like my comfort with this decision and the resident experience and being able to like stay in this for a long time. And I know the returns that I'm signed up for right now versus chasing, hey, let's add another property to my portfolio. Let's add some more return to this thing. Like I feel like you're just like very comfortably in your lane of understanding exactly how much risk you like to take, the return that you signed up for, and you know exactly how that return is performing. I don't think we've talked about that, but like, there's no chance that you don't have a number for exactly where you're at right now. It's is my assumption, and I assume that you're just like, if you didn't like that, you'd either be like moving into another asset class or you'd be switching your strategy. But it feels like you're just very comfortable in the lane that you've set for yourself.
Yeah, maybe too comfortable. That's the rich, right? The rich side of my brain, or maybe I gotten too comfortable where I'm at. And when I look back at that event, right, the reserve I set aside that was part of the deal, part of the numbers I ran when I bought the property, that was $6,900. So it really was less than my deductible that I had to came out of the other property reserve, right? But the portfolio covered that. But even if it had just been my only home, right, I would have been on the hook for about $1,200, not $2,500 if I had to come out of pocket. So that discipline, even if it had been the only thing I owned, that discipline would have made it an easy call to go take it out of the reserves and not go the insurance route. So I think the discipline, keeps you safe. So like pre-flighting the plane. Don't just get in it and fire it up and hope for the best. Check it before you take it up in the air, because it better be on the ground wishing you were flying than in the air wishing you were on the ground.
I was waiting for a pilot metaphor. I was just waiting for that. So that being said, then Geoff, if we are balancing this idea of like risk reward, knowing yourself, discipline, and comfort levels, when you think about, we're talking about this moment of taking advantage of an opportunity with these like incentive package, this idea of buying down points for like the 5% mortgage. How would you analyze that in your investor brain?
So it certainly makes I look at a property, okay, I'm gonna have to put a certain amount down, right? Get to the core math, right? You put a certain amount down, you get the property, then you finance the rest. Then you've got the interest rate determines your mortgage payment plus principal interest and all those factors, paying for the property tax, those things. Then you got to factor in your reserve. And then what's left is your cash flow that potentially is free. And I think of that's got to be a positive number in my mind, and that's got to have some buffer in there, because you never know. There's a bunch of forecasted assumptions maybe in the rest of it, like what rent will be, the vacancy rate could be. You got to have a little buffer in there. And then if that comes down and the ROI comes out to a number that's a good number for what I think I need to get in a return, then buy 1, buy 2, buy 3, buy 4, buy 5, buy 6, depending on how much DSCR lending you can get qualified for. And the other thing I would say to people is, if you get the first one, having one after 2 years, you've got rental income on your tax return. You've proven you have a successful model to survive. That means the debt to income ratio becomes much less a factor on your own financing. And I know we haven't gotten into all those gory details of how I think about all that stuff. But, having rental property now, I don't think there's a limit in terms of like DSCR lending and stuff. How many rental properties I could qualify for? I could probably go buy $20 million from JWB and get financing for that if I had the down payment to make it work, because they aren't looking at my credit score beyond, okay, you've got a credit score that's respectable. They aren't looking at how much money I earn to figure out how much they'll lend me. They're looking at how much will the properties earn when they're figuring out if I qualify for lending.
Can you explain it to me?
Yeah, absolutely. So they're looking. No, this is perfect.
No, that was great. Like this is a learning opportunity for me.
Well, so again, sometimes people say, "Oh, geez, Greg, you've been buying these properties for 20 years. You're so lucky. You should have bought 10 years ago or whatnot." And what I try to share with people is like, listen, the world 10 years ago or 5 years ago or 20 years ago is completely different. It's not just comparing what prices were 20 years ago versus what prices are today.
Mm-hmm.
Lending is a huge part of the equation.
Mm-hmm.
And so the lending products that we're talking about here as a part of JWB's incentive package just simply were not available even 5 years ago, not available 10 years ago. There used to be limits on how many rental properties you could get financed.
Mm-hmm.
So if you had all the money in the world, you had perfect credit, no matter what, you had the perfect rental property to buy, you couldn't just go and get a loan if you had over 10 finance properties.
Mm-hmm.
And even back in the day, many people don't remember this, but the limit was actually 4 for a period of time. And there just were not readily available lending opportunity loans available beyond that. So what Geoff's sharing here, and this is a part of the incentive package with JWB, we know all of those lending packages. They're readily available for all of our clients today. There are what are known as typical conventionally financed mortgages, which are always readily available. But there's another product called a DSCR product. Stands for debt service coverage ratio. And don't worry about debt service coverage ratio. What does that really mean? It means at the end of the day, the bank is making sure that it's cash flow positive. So they're looking at it the same way that you're looking at it, or that you're looking at potentially buying the property. And the bank is saying, well, if it produces income each month, well, then I probably want to lend on it. And so they value that as much or maybe even a little bit more than your personal finances. Now, you still have to submit some of your personal finances and all that because you still have to have a good credit score and whatnot. But it's a different type of loan product. And now this is right in our wheelhouse as rental property investors because we focus on supplying inventory and supplying properties that are cash flow positive. The lending arm is there. And, when you take advantage of it with an incentive like this, you can even get, as low as a 5% rate, taking advantage of the incentive. So huge opportunity that just wasn't there 5, 10, 15 years ago.
Jeff, what do you mean by that whole part of like acquire one? Like when I look at your buying plan, it looks like you acquire like you acquire kind of like in bunches, right? Like, so what is the explanation around acquiring one for this?
Well, when you get your first one, right? So the lender's gonna lend on that most likely based on your personal financial position. After you've proven you can run a rental property, you can start moving the conversation to, I'm an experienced rental property investor. Here's the numbers. Here's the math on the property. And to Gregg's point, right? It's going to be cash flow positive. That's what's going to allow me to pay you back. It's not my W-2. It's the property. So the conversation can get shifted. And generally speaking, what I've heard is 2 years of rental income on your tax return gets that. So if you don't have enough for 3 and you can get to 1, we'll get to the 1 and then save up to the other 2. And when you get to that conversation 2 years down the road, buy the next 2, it's a different conversation with the lender to some extent. Now,
it's another one of those. Oh, sorry, go. Yeah.
I was going to say, now buying more, right? If you have 3, that's a risk mitigation strategy, right? When I look at that, right? Buying in tranches. The bigger the portfolio, the less that hurricane damage at one of my properties, right? The other properties have reserves as well. And, you're guaranteed something's going to go bump in the night. If you have one, it might be you that gets big bump. If you got 10 properties, it might be 1/10 of you that gets the big bump, right? So, and I go to 10 because I like easy math. And so I'll go from 10 and then I got to buy 100, another 90 properties. So I get to 100, right, Craig? So keep even simple. Yeah.
Yeah. And I'll just give an update too. What you're talking about as far as the rental income becomes easier at the 2-year mark. But now there's loan products that are available that actually count sometimes all of your rental income and sometimes a portion of your rental income day one. And so what that, a lot of times people will say, well, I don't even know if I could buy 3. I have the capital, but it's going to be hard enough for me to, get approved for 1 or whatnot. Well, what I share with folks is many times it's just as easy to get approved for 3 now because of these advancements in lending products that are available and they understand that they can count rental income. So it's just as easy to get approved for 3 as it is for 1. That's why many folks are buying in bundles. That might even be since you purchased your last property, Jeff. I think, when was the last time you purchased a home? Was that a few years ago? A couple years ago?
2022.
2022. Yeah. So that might have even changed. So there are so many advancements and better lending opportunities today than were there.
It's so interesting.
Does having the property through JWB with your proven track record help open that door to that type of financing?
Well, I won't say it's only from JWB. It's not specific only to our relationship, but it's a part of the value of working within our lender network. We are only going to work with lenders that are able to count either a significant portion of the rental income to offset the debt to income ratio to make sure that the ratios work. So we're only going to work with lenders that can do that to make sure that our clients can actually, take advantage of it. If you just go out on the streets and you talk to any lender, very, very likely that it will be at least 2 years before they can count your rental income, if at all. So yeah, big value of just working with a team that's done this thousands and thousands of times.
All right. Now I want to say that thing that I was trying to say.
Go for it.
I just, like my journey on this show started off as a guy that really didn't understand any of this stuff. Right. And I was asking questions to get informed myself. And I get fewer and fewer moments where I get delighted of like, oh, I didn't know that. And this is another reason why to do this, right? Like there was like a big ramp up period. And they always come around this idea of these externalities that happen by owning rental properties, right? From like understanding 1031 exchanges intimately, from understanding cash out refinancing, understanding this DSCR loans, and really being able to like, at first I was like tapping that into this idea of like having more options when you're at your most vulnerable, right? Like building this retirement fund in an asset class that continues to have better options as stuff goes on. And this is a new one to me, right? Like this idea of getting like I was told when I first started investing with JWB, it's about getting on base, right? Like, and you might hit a single, you might hit a double, you might hit a triple, but eventually you get all these runners on base, and you're gonna get them home, which is when you're like living off of this cash flow. But the idea of understanding that if you get on base and you get a property and you pull forward demand, maybe not knowing how you're going to get to three, but you're like getting one property, having income from a property by itself allows you even more options when it comes to lending, and when it comes to these financial instruments that you have access to, just continues to bear fruit of a reason why no matter what I do, I'm always going to want to have real estate. I'm always going to want to be a real estate investor in this asset class because of these options that open up that other people don't get. That was my aha moment.
Very true. I think, I am so lucky that I landed in this asset class. Remember, I was 23 at the time, so I won't say that I was so thoughtful about where I was going to go. I didn't understand what I know now, but I am so thankful that I landed in an asset class that has all these wonderful things going for it. But more than anything, the financing structure, the cheap, accessible, flexible financing
Yeah.
is the basis of why this asset class is so incredible. If you're out there looking for business opportunities, look to the debt structure first, because that is going to drive what your significant opportunities should be. It's about the debt as much as it is about the asset or whatever you're investing in. Again, the debt here is so incredible for single family rental properties, and it's the reason why it's so scalable, and it has made more Americans wealthy than any other asset class.
Yeah, there was
Awesome.
a thing of beauty to that 30-year fixed rate debt from a predictability, right? You're locking in probably your single largest cost for 30 years as then a known number. You know that number for 30 years. There's not a lot of other investments where you can take, I can't tell you what Berkshire Hathaway cost structure is going to be for the next 30 years. And I would bet you Warren Buffett can't either.
Yeah. It's crazy to think that you can secure that for 30 years, because there's people on the other side that are saying, you know what? I'm going to take that for 30 years and I'm not going to change it on you for 30 years. There's investors on the other side, and our government supports that relationship, and other governments do not support that relationship. And that's why when you go to other countries and you ask them about what's your mortgage like on your home, they're like, well, it's adjustable rates. It's a balloon in 5 years. I have to think about how I'm going to refinance it. It's because normal individuals do not typically make 30-year transactions. But in our country, we facilitate, as a government, we facilitate this. And we, as rental property investors, get to take advantage of this. And it's so critical for why this is such a wonderful asset class.
Love it. I love it. This was awesome. John Williams, El Maestro, put in the chat, I'm really enjoying this show. The knowledge that is shared is great. And I have to agree. Like I could just sit here, fly on the wall, listen to Geoff and GC talk here. Really, really cool, kind of like high level strategy, Geoff. You are the new king of acronyms, because we have not seen Zach Correa around here for a while. So that's what we're gonna start calling you, Lord Geoff Bolton of acronyms.
Oh, geez, I got promoted from sir to Lord, and Pablo, I think I need to have you write my online dating profile for me based on your self-aware.
I'm really good at that. I award you lands and a title, Sir Jeffrey Bolton. Now, thanks for doing this, man. I know that I know you're a private guy. I know this takes a little bit of courage to come on here and do this, but you've shared so much value and like sharing your framework Really, really cool, man. So just really awesome for you to do this. Really great kind of participation from the chat today. There's a great conversation around proactive tree trimming, conversation around how other people's like LinkedIn Lowry and the Ringmaster have their own systems kind of like yours. I love community, always adding value to this thing, always making this like a really comfortable space to have these conversations, and just really, really cool. So thank you for showing up. You're the reason, you guys are the reason why this show is awesome. Next week, GC, do you know what we're talking about next week?
You know
I gotta look at
what are we going to talk
What
about?
are we
next
talking
week?
about?
Hopefully, our amazing Airtable will tell us.
Yeah, I should have been ready for this one. Oh, we're doing a behind the scenes. Is this was?
Oh, that's a live property demo that
We're gonna do the live
Oh, I
property-
can't wait to do
live
this,
property
guys.
demo. Yeah.
Guys, if you all remember the property of the
Wait.
All right, we're bringing it back. We're bringing it back next week. There's a little different flavor to it. It's going to be helping you choose an asset. I'm going to take you behind the scenes, just as if I was still on the phones for JWB. And let's say you're a prospective client thinking about how we're going to build your portfolio. What assets are we going to choose? What rental property? Why are we going to choose them? We're going to take you behind the scenes and show you how I would actually select your ideal portfolio. I want you all to show up with questions. You can fire situations at me. I'm going to be wheeling, dealing live, and you guys are going to see everything that we do. So I think you're going to get a kick out of it.
Wheeling and dealing live. We're putting Gregg on the hot seat, put an Excel sheet in front of him and the computer screen. You guys are going to see magic. Gregg is a world-class Excel manipulator.
Fresh off the Excel World Championships in Vegas.
What's that?
Didn't have a Chinaberry tree in the backyard?
No Chinaberry tree.
No. Geoff, tell everybody to look out for Chinaberry trees. I know you got a point of view on that one. All right, y'all. Well, this was awesome. Any last piece of advice for folks, Geoff, before we log off here?
I think the one thing is the plug, right? Like, Pablo, you're doing this, you're on social media. Yeah, uncomfortable, awkward for me. I tend not to want to put my face out there, especially on such a large platform. But, when I was looking at rental property and when I talked about DSCR loans and all that stuff, a lot of that knowledge comes from YouTube University. I started out on the early days with Nick Kevin and Dion Talks Financial Freedom, one rental at a time. There's a wealth of information out there that was not available 20 years ago. And it's because of shows like this and teams like this that are willing to put it out there in the ether and people will consume it. So it was a gamble, Gregg, and a bit of a leap of faith with you too. I know that back in the day, and I just want to express tremendous appreciation. I wouldn't be here if it wasn't for those types of products and content being put out there. So a big thank you for that.
You know what? Got goosebumps, Geoff. I didn't know you're going to make me get goosebumps today, but you did. I appreciate that. I mean, this show and this journey has been incredible, and getting to serve clients like you who care so much more than just about making a buck is what it's all about. So thanks for being such a big part of the community. Can't wait to do it again next time.
Heck yeah, man. Hope to see you on the next one. Yeah, right. We'd love to have you back. Any last piece of advice you see? Don't be average. See y'all next week.
See ya.